everyone, welcome to the podcast today. We are so lucky to be catching up with Tim Lawless at CoreLogic. Tim, how are you?
G'day, Jack. I'm well, thanks, mate. Thanks for the invitation to be part of your podcast.
You are a man that needs, obviously, no introduction at all. Tim Lawless, Head of Research at CoreLogic. I saw you speak, I think I've seen you speak maybe 3 times now. And last time I saw you, you mentioned that you'd been last year alone, you did about 300 conferences and meetings and invites and whatnot. So we're very lucky to get you, mate. So thank you so much for your time.
Thanks, mate. I can honestly say the Australian sector's appetite for anything that's property related is insatiable. So it's not surprising to see. I think anyone who's got a focus on property markets will be torn from left to right at the moment.
Yeah, no, absolutely. So thanks for spending the time with you, mate. Where I want to start is I'm going to shoot some capital cities at you, and I want you to just give me a number out of 10 based upon what your confidence is in that city from a property investment perspective. And we'll just do a few, and then we'll circle back and speak about a few of those. So Adelaide.
6.
Okay. Melbourne.
4.
Okay. I reckon that's optimistic. Perth.
8.
Brisbane.
7.
Hobart.
2.
Okay, all right. There's already a few ones that I want to talk to you about there. That's interesting. So you've rated Hobart below Melbourne. Why is that the case?
Yeah, I mean, Hobart's come out of a pretty strong growth cycle. I mean, it's been weak for a couple of years now, so this is nothing new. And arguably that is a bit of a silver lining that affordability is improving and so forth. But it just has a really weak demographic trend at the moment. You can see interstate migration's gone heavily into negative the last couple of years, and it doesn't look like it's turning around. Doesn't get much from overseas migration. So the demand side is relatively mild in Hobart. It is still a relatively unaffordable market as well, given the previous cycle of extreme strength where Hobart was probably outperforming most markets up until the rate hiking cycle. So mostly for those reasons, Hobart probably doesn't have as much elasticity in supply and demand as you might find in other markets. It's not as responsive or reactive just because it is a small area, kind of like Darwin. But yeah, I think for those reasons, it's going to be a little bit of a tough market. But maybe I should have qualified those off the cuff ratings for each city are probably more immediate. I think for a lot of these markets like Hobart and Melbourne that are underperforming at the moment, you'd have to think their longer term view is getting a little bit better given affordability improvements, improving rental yields, that sort of thing that ultimately would make them more attractive down the track.
Okay, super interesting. So with regards to, I'm a Melbourne man myself, and I'm just looking at the budget and also looking at a mismatch between supply and demand in houses. What is you've set a 4 for Victoria or for Melbourne? What are the driving forces there, do you think, that are happening? And what do you think is going to happen on a short, mid and long-term cycle for that particular state, just with those particular nuances in that state?
Yeah, I think the taxation environment is a pretty big factor at the moment. There seems to be a significant disincentive for capital flows coming into Victoria, given the lower land tax thresholds, vacancy taxes, tourism tax, if you want to call it that, for Airbnb properties or short-term stay properties. Stamp duty is a lot higher in Victoria as well. So it does seem to be fairly heavily property tax, which anecdotally at least does seem to see a lot of people are looking to move out of Melbourne from an investment perspective, looking for greener pastures. But I think there's more to it than just the taxation environment. You can see kind of like Hobart, but to a lesser extent, a fairly weak demographic trend in Victoria. Once you remove the impact of net overseas migration, which has been significant, but most of that tends to flow into rental demand, given the large majority is foreign students. It doesn't really flow through to purchasing demand. And we can already see migrations coming down, net overseas migrations coming down. Rental pressures are just starting to ease off a little bit. from pretty extreme levels. Interstate migration still negative. Yields are very low, second lowest after Sydney, but rising. I mean, Melbourne's one of the few cities that's showing a rising yield profile and is showing also an improving affordability trend. So, yeah, to your point, the medium to long-term view on Melbourne is very different to, I guess, the more immediate view. And you'd have to think that once Victoria digs itself out of the debt hole that it's currently in and hopefully winds back some of these taxes and affordability improves and yields are looking more attractive, that's where we'll start to see a stronger market performance. And logically, getting in before that, getting in while the market's quite flat or if not falling, is probably a good long-term strategy. It just means you probably don't have the immediacy of capital growth.
Okay, that's interesting. So would you invest in, say, Victoria on a long-term basis relative to what some of the other states that are performing really well, such as Perth or Queensland right now?
I think that's probably fair enough. To be frank, I don't do a lot of property investment. Kind of like I used to live next door to a painter, and he had the worst painted house in the streets. That's kind of an analogy for me. Pretty conservative, but if I was to be investing and say I had a spare 500 grand or something like that, yeah, I definitely wouldn't say Victoria's off the cards. I think there's much greener pastures at the moment that might give you a stronger return, both in a yield and in capital gain over the next couple of years. Perth and Brisbane are probably the two obvious ones. But yeah, getting the timing right for Melbourne, maybe in a couple of years' time, buying into that market after it has been through a period of softness, I think is probably a legitimate strategy. And trying to pick the timing of the market is very hard, and most people would do it through luck rather than through any real playing with numbers. So do in retrospect, but at the moment, I think there's definitely some better options in Melbourne.
Perth, obviously, I've had a look at the numbers that come out of CoreLogic, which is saying that they're growing at an annualized basis of around 25% or something absolutely crazy. Relative to Melbourne, which looks like it's in a period of negative growth. Right. Is that a decent investment strategy? Just purely because I would have thought that there's just a little bit of danger there, just purely because of the fact that they are heavily reliant on income that comes out of mining, and if that switches off due to geopolitical sort of stuff that's happening in China or whatnot, that will have a pretty heavy impact on the Perth market. How do you feel about that sort of market noting the fact that it is 25%-ish today? Do you think that will continue long into the future of a 5 or 10 year sort of trend line?
No, I mean, there's no way that the rate of growth could be sustained as quickly as it is at the moment. Affordability would just become completely unhealthy, and people would stop going there because they couldn't afford it. So at the moment, we're seeing Perth housing values rising at about 2% month on month. And as you say, getting pretty close to sort of the mid-20s on an annual growth rate. Dollar terms, it's like $14,000 a month rise in values across that market. But it can't be sustainable. But there is probably still some legs in the Perth market. Even though we've seen such a rapid rate of growth, it's come from a pretty low base. Mm-hmm. Remember, Perth coming into the pandemic, it had come out of a long-running downturn post-mining boom, which, as you say, Jack, it's a really good reminder that absolutely, Perth is a volatile market. It tends to go through periods of extreme growth and then periods of a downturn or flat conditions. So, and it hasn't really seen the economy diversify a lot. It's still heavily dependent on big mining projects, or maybe more specifically, big infrastructure projects associated with mining. To be honest, it's hard to see demand for iron ore and gold, some of the smaller commodity markets as well that come out of WA. It's hard to see them, completely tanking. I think considering how much infrastructure development's underway and the need for iron or steel, it just seems to be a difficult proposition. But then again, who knows? With a trading partner like China, for example, things seem to be mended there and improving. But there is a lot of volatility in those trading relationships. And yeah, Perth does have quite a bit of exposure to it. But on the flip side, there are some really big infrastructure projects that aren't mining related in WA, particularly transport centric. and the market is still pretty affordable. Looking at, say, affordability metrics that adjust for income, Perth is still sort of middle of the pack, if not sort of towards the bottom of the pack for housing affordability. So, and yields are high, much higher than most other markets apart from Darwin.
One more market that I want to explore with you before we move on is the Queensland Brisbane market. And that is just, it's not seeing the same level of growth as Perth, but it is seeing a pretty decent level of growth. Now, when you speak to, the property investor off the street, the main sort of hot word that you see coming from them is the Olympic Games. And obviously, that seems to be a sort of buzzword that's kind of pushing a lot of that market up to the 2028 sort of spot. And I just wonder, from your opinion and your point of view, how much of this market is being grown, or the demand for growth, as a basis of an index of just people having the confidence as around, just around the Olympic Games, and how much is it relating to external factors such as, the sort of demand, supply, match, and that sort of thing in that particular market?
I don't think there's a huge amount that we could, attribute to the Olympics at the moment. Absolutely, I mean, it's an upside. It's certainly not a downside thing for Brisbane. Still some way off, and there's still a lot of deliberation about which infrastructure projects are going to be going ahead, where the stadium's going to be located, all that sort of stuff. So there's still some uncertainty, but I think what is certain is the Olympics are going to go ahead. We won't pull a Melbourne as such and cancel
Too soon.
And there is going to be a lot of big infrastructure projects, not just around the sporting events, but also around transport improvements. A lot of them are already underway, like the Cross River Tunnel and so forth. So that aside, there's a lot of other factors that are really providing some momentum to Brisbane's growth. And on that, you can see interstate migration is significant, and it's holding well above average. It's come down from the pandemic highs, but it's still way above average and looks to be settling in. So I think that that cross-border flow that does have a much stronger correlation with purchasing demand than what overseas migration does. It's more correlated to rental demand. Mm-hmm. That's really driving particularly Southeast Queensland, but even some regional markets around Queensland. Then you've also got, I suppose, a lower price point relative to Sydney. It's getting a lot harder, though, to argue Brisbane's affordability advantage. It's now got a median value that's the second highest in the nation after Sydney. When you adjust for local incomes, it's probably third highest after Sydney, then Adelaide, interestingly enough. So, yeah, it's definitely seeing some barriers around affordability, but I think that the population growth and the backdrop of very low supply levels, and like everywhere around the country, very little in the way of a pipeline of new supply being delivered, is going to be a real factor in pushing prices higher over the long term for Brisbane.
Okay, super interesting. What I want to do is zoom out a little bit and talk about the property market at a macro level from an Australian perspective. There's a few things going on here. Obviously, there's still a bit of rate pressure as a result of the CPI figures that are coming out. You've got Michelle Bullock, who appears to be this is even if the CPI numbers were where they needed to be, but appears to be quite hesitant to let those numbers come off, just because they know that that's probably going to kick off another housing boom, because it will send a message to the property market saying we're on the right way out. And I just wonder how much of that is being driven from interest rates alone, or is that really just a band-aid for what we're the greater problem here, which is there is just a fundamental mismatch between the supply of housing relative to the demand of housing, particularly with reference to immigration rates at the minute, which are all-time highs that we've never seen before.
Yeah, I mean, there's a lot to unpack there. So, I would definitely attribute the performance of the housing market, which is quite strong, at least at a macro level, to the mismatch between supply and demand. And probably I'd place more emphasis on the supply side than the demand side. We're seeing transactional activity, for example, roughly around the long run average across most markets, higher in some of the stronger markets and some of the more affordable markets. But we're definitely not seeing housing activity in terms of the number of homes being purchased, skyrocketing or anything like that. But what we are seeing is that average level of demand playing out against a backdrop of well below average levels of supply. Yep. So I think it's more a supply side thing. With regards to interest rates and the broader macroeconomic environment, normally when you have elevated interest rates, extraordinarily low consumer sentiment that's hanging at this very low level the last couple of years, cost of living crisis, a relatively conservative lending sector as well. You can see that in high debt to income or high loan to income ratio loans are a pretty small portion of lending. Generally, all those things will be placing downwards pressure on prices. And clearly, we're not seeing that at the moment. It's the opposite. So I definitely attribute this strength to just the supply side. And ultimately, that will be addressed. That will be fixed, either through demand coming down to be where supply is, or through eventually a supply response, and probably a bit of both. We can already see that migration is coming down. In fact, it peaked back in the March quarter of last year. Migration is coming down pretty quickly. Hasn't quite normalized, but that will happen. So we're now starting to see now, I guess, a more normal demand side environment. What we're waiting for now is a supply response. And most economists think that'll probably start to come out of the ground maybe around the middle of next year, when capacity constraints are freed up a little bit. Hopefully we see established prices rise enough to be where the premium for new builds need to be as well. Because at the moment, for a lot of builders, they just simply can't get stock into the marketplace that has a profit margin associated with it. It's unfeasible. So I think a lot of things need to change for us to get more newly built supply into the market. And remember, the federal government's 1.2 million well-located homes target goes live from next month, from the 1st of July. And I wouldn't be surprised if we see a real focus on policy around stimulating more housing supply, both from the federal and the state government level, aiming to meet that target, which at the moment is looking like quite the stretch.
So at 1.2 million homes, can we just delve a little deeper into that? Over how long are they when are they expecting to deliver that by?
Well, it's over 5 years. So it's the 5 years starting from July 1st, 2024. So out to 2029. Just to put that into context, over a 5-year period, Australia's never built 1.2 million homes in their entire history as a country. The closest we got was just over 1 million homes over the 5 years ending December 2019. And that building boom was very much characterized by a surge in high density styles of dwellings in Melbourne and Sydney. As well as a lot of foreign investment. And both those things just don't seem to be happening at the moment, especially when you look at approvals. Medium to high density approvals have been languishing at well below average levels throughout the pandemic. There really wasn't much of a response during the home builder phase. Most of that was geared towards detached houses. Although there are still a lot of high-rise and medium-rise buildings that have commenced construction and haven't completed. So maybe that's the low-hanging fruit here, is that a lot of that already approved and commenced product can actually get delivered to the marketplace once we do see it becoming more feasible to do so.
So I would have thought the way to stimulate that sort of stuff happening is to be able to give some sort of incentive to builders, or some sort of tax cut, or some sort of something to just sort of make it a little bit more feasible, particularly in the good state of Victoria, where you've got cost of materials, your cost of labour. And from exactly what you said, from a feasibility perspective, it's just too difficult. So question for you on all of that is 5 years, are they implementing any of those sort of incentives to make that happen? And is this a decent goal? Or, I mean, obviously it's a great goal if it could be achieved, but do you think it can be achieved, or is a lot of this just sort of pandering to the cameras?
Well, let me start by saying this. It is a good objective to have. It's highly aspirational, and go back to corporate speak for a little while. It's a stretch target.
Yeah.
And if we meet it, fantastic. But at least it's something to work towards. I don't think the country will get there, to be honest. But even if we get close, I mean, that's a good outcome. So, and you're right, I think, Jack, that there does need to be a lot more stimulus. We probably will find that in the coming years, that we will see things like taxation incentives or advantages. There's already things like that for the build-to-rent sector. Maybe it needs to be more significant around, halving withholding taxes and doubling depreciation benefits are just an example of that. A few other examples would be, we have seen some states incentivizing builders with low interest loans to cover their infrastructure costs, or even supporting infrastructure costs through grants and stuff like that for strategically located projects. I wouldn't be surprised if we see more of that style of incentive or support for the industry aimed at facilitating or kickstarting the industry, particularly for really important projects that might be high density along transport spines in high amenity zones, or where there's a real requirement for social and community housing, that type of thing. And that's the probably the segue here is we have already seen a significant uplift in social and community housing funding. The only problem there is it's a really slow burn. There's no immediacy to this, that we still need to build the product.
Yeah. Okay. So it seems like supply seems to be the big variable in all of this, and from a lot of perspectives. But particularly it seems like CPI would come off if we could get housing prices down, and that is obviously going to come from an increased supply relative to demand. So it seems like it's all coming back to that one factor, which is why it is obviously a priority for the federal government, also in partnership with the state governments, to push that forward. With regards to the Australian market, or the Australian property market as a whole, what's your confidence in it from a macro perspective? And if we're talking about, potentially immigration from overseas, and it is a sought after country to be in, when you're looking at particularly the Chinese market and the Indian market, what is your perspective of the Australian property market as an investment at a whole group level over the next, say, 5 or 10 years, as we encounter these immigration rates from overseas, particularly relative to, again, this supply-demand mismatch that's happening in the market as well?
Yeah, I think it's a pretty solid investment. And remember, most Australian investors are very focused on capital gain. Yield, for some reason, seems to be an afterthought. So maybe that's one of the sticking points for institutional investment or foreign investors, is that you're looking at a yield profile for Australian housing that's generally sort of in gross terms below 4%. Add to that the capital gain, of course, and it becomes much more attractive. And then you've also got the cyclicality of the Australian market. For people who have this misplaced belief that housing prices only rise, clearly that's not true. The market is highly cyclical, and you'd only have to go back to the middle of 2022 to see we had a 7.5% drop in values in a year, or a little bit less, more like 7 months in the early part of the rate hiking cycle. Before that, we saw Australian housing values fall a bit more than 10% between the middle of 2017 and 19, as credit became much less available during a period of macroprudential and the Royal Commission into banking. Before that, it was as interest rates were rising after the post-GFC stimulus. So there's definitely periods where housing values fall, but when you take the housing market over the long term, the periods of rising values are much more significant than the periods of falls. So I think in that sense, housing does tend to be a fairly stable asset class. It doesn't have the same volatility as you'll find in equities. It doesn't have the same liquidity either. So you have very high transactional costs in housing, not as much liquidity in equities, of course. So it definitely has its pros and cons, Jack, and no doubt you and your listeners are well aware of them. But I think a diversified portfolio, in my view, is always the best option, and housing seems to be a fairly good component in that diversified portfolio.
The federal government is talking about, it's super topical at the minute, immigration, obviously, something that's being talked on both sides of the House. And the question is, if they are looking to reduce those immigration numbers, do you think that's going to have a lasting impact on our property market, or do you think it will continue to be buoyant just purely because it's a sought-after place to be on the planet at the minute?
Yeah, I think it will continue to be buoyant. And even though migration numbers, they're already coming down, and a lot of the boom we saw in migration was just simply catch up, and most of the migration is non-permanent. They're temporary migrants coming here as students. So most of that migration flows into rental demands. And I think there's a real argument to say that we definitely need more permanent migrants in the skilled migration program, particularly for particular skill sets like what's involved in residential construction is a really good sort of focus area. arguably there's not enough of it. And if you really want to have a more immediate supply response, then you need the people who are going to be building the dwellings, as well as there's a lot of competition with the non-residential construction sector being big infrastructure projects, which quite often compete for the same skill sets and materials.
Mm-hmm.
So with that in mind, I think the migration debate is probably more of a populist one and a political one. And we're already seeing migration normalizing just through the catch-up playing out rather than any policy shifts. But going back to your question more specifically, if we do see migration coming back to, say, average levels, I really don't see that being as a big deal. It'll probably result in less upwards pressure on rents, which is where most of that migration seems to flow through, that demand. But at the moment, our rental markets are extraordinarily tight. So I'd have to say that's probably a good outcome, given the fact that we've seen rents just surging in most markets and rental affordability becoming a real challenge.
Yeah, affordability is an interesting one. I saw a stat recently which talks about the Sydney market and its household affordability, which was a component of household income relative to the median household price in that capital city, is the second highest in the world relative to Hong Kong. And that's an interesting stat. Now, is that a temporary thing that will level off at some point, or is that an indication of sort of what's coming in the future and the new norm?
Well, I think some of these statistics that try to compare country to country affordability or city to city, they're useful, they're relevant, they're interesting, but in many ways they're not really apples for apples. Like, it is hard to compare Hong Kong with Sydney. Point to me a detached house in Hong Kong, whereas Sydney still has half the dwelling stock are detached homes. And if you're looking at the unit market, it's pretty rare to find, say, a 45 square meter unit in Sydney still. It's hard to get finance for them. So it's not really an apples for apples comparison, but I get the point. Sydney is expensive, and I'd certainly put it on the global stage in terms of its lack of affordability. Just looking at some of CoreLogic's numbers, we put a median or a dwelling value to income ratio in Sydney at about 9.7, meaning you're spending about nearly 10 times your gross annual household income to buy the median price dwelling. And if you're to get a loan, say an 80% LVR loan on the Sydney median household income, you'd be dedicating about 60% of your gross income, once again, to servicing that loan. Now, of course, most lenders aren't going to lend on those sort of ratios. So what it probably means is that more buyers, so if you're on the median income again, you're probably being skewed towards the lower quartile of the market rather than the middle of the market, simply because that's where you'll be able to get credit or be able to afford to buy a property. So yeah, affordability is really quite a challenge, and Sydney's been unaffordable for a long time. It doesn't really seem to have stymied its growth as much as what you would have expected.
If we go back to Melbourne as a market again, and we're looking at I'm seeing stats that are coming out saying a lot of investment property is getting dropped off. And I would have thought that's as a result of your taxes, as you were talking about earlier. A lot of the taxes with regards to just holding property is getting too much for some people, and they're looking to offload those investments. And I would presumably expect those to be replaced with owner-occupiers who are saying, I understand it's probably not the best time from an investment perspective, but I'm buying the family house and, I'll live here for the next 15 years and I'm, more interested in looking after the family. Is that the case? Is it investment moving to owner occupier, and what impact do you think that's going to have, particularly to renters, noting that you would think that as there are less investment properties and investment stock, you've therefore got a lower market, and therefore you would presumably have to compete with the same renting cohort to be able to get into a rental property, which I would have thought is going to drive up rents. But then again, you can also look at it on the other side and say, the rental market is not as big because a portion of those guys are moving into owner-occupied housing. So, bit of an interesting one there. What do you think about that one?
I'm definitely hearing similar anecdotes about investors selling out of Melbourne and looking towards greener pastures where there might be better capital gains on offer, where yields might be better, where the taxation environment, of course, is lower. It's hard to prove up, to be honest. We've definitely, if you look at the housing finance numbers, it's clear there has been a rise in new investment activity in Victoria. So the value of investor loans is up about 17% over the past 12 months.
Okay.
That sounds pretty impressive. It definitely suggests to me that investors are active in that marketplace. But compare that to other markets, like WA is a good example. In WA, the value of investment lending is up 70%, 70,
Wow.
compared to Melbourne's 17. So, and if you look at proportional data, say across Victoria, around 29% of lending is to investors, whereas in other markets, it's getting closer to sort of 40% or even higher than 40%. So it does look like Melbourne is less popular from an investment perspective, that's for sure. It's just hard to prove up if they're selling or offloading and who's buying them. A lot of that is anecdotal, but it makes sense to me that we would be seeing more investors getting out, given that the higher holding costs and maybe also just the better or greener pastures outside of Victoria from an immediate perspective.
Okay, that leads me nicely into the next question, which is, what's your confidence in the Australian property market over the long term for local investors, international investors, and also homeowners, owner-occupiers?
Yeah, I mean, I'm generally fairly buoyant and wouldn't say bullish, but yeah, I think our property market is. If you look at the long-term history, it's been a fairly strong investment opportunity. Generally, a lot of people look towards doubling the value of your property every 10 years. I wouldn't say that's the case everywhere. If you look at the annual growth rate over just the past, say, 20 years at a national level, it's around 5% per annum compounding, right? So to get your doubling, you need a compounding growth rate of 7.2, of course. So there's not too many markets that actually tick that box. But generally speaking, it's pretty hard to find any markets where values have gone backwards for any long period of time either. So it does look to me like a fairly solid investment option. Of course, there are going to be discussions and debates around the taxation environment, negative gearing, or capital gains tax concessions. I wouldn't be surprised if they do become more debated as we approach a federal election. So maybe that's a bit of a risk there around just the taxation environment. But I think even without that, I think you'll probably find that the long-term view on Australian housing is going to be quite similar to what we've seen historically over the past 30 or 40 years. Some cyclicality, some ups and downs, but generally speaking, a consistent rise once you read through some of that noise.
Okay, let's talk commercial property relative to residential property. If I was looking to purchase another investment property, would you be more bullish on a commercial property or an investment property at this point, just based on the macro environment and what's happening out there?
It really depends on your investment philosophy. And just to qualify, my focus as an analyst is absolutely residential markets.
Oh, yeah, I was going to ask that. Yeah, okay, sorry.
I do pay attention to other assets. But before I answer, I just wanted to make sure I put that out there. Sure. So if I was to look at, say, non-residential, I mean, there's a whole range of options here. You've got, say, office, which is pretty weak. But generally, if you're buying into, say, the tertiary styles of office markets being lower grade, that's where there's a bit of pain at the moment. There's a real flight to quality towards A or premium grade styles of office buildings. So, but anyway, that's generally, some big bucks to get into that market. A lot more sort of retail investors will be looking at things like warehousing. That's doing extraordinarily well. The yields are huge. There's a lot of demand. Logistics is very strong, but even just local storage seems to be a very, very strong part of the economy at the moment. And small businesses operating out of sheds, for want of a better word. Retail is looking a bit tough, it seems. Probably a big part of that is just the pullback in consumption, and households are really feeling the pinch and really trying to focus on spending on non-discretionary areas. So I think retail will be a little bit tough. So if I was probably, again, from my unqualified perspective, I'd be probably looking towards industrial/warehousing as the best opportunity there that has this, what seems to be a pretty solid mixture of capital growth and very strong rental returns.
Okay. All right. That makes perfect sense. Now, I've got one more thing I want to do with you, and I didn't tell you I was going to do this, so apologies for that. I want to play a game with you where I don't know if you remember the games we used to play in economics at school, where they used to give you $1 million and you used to have to invest it in the stock market, and then whoever had the best investments got the best growth at the end of the semester won. I want to play the same game with you, which is, if we've got let's just say you had $2 million today, which markets would you be investing in around the country? And I want you to specifically mention whether you'd be, I know that you're more interested in residential, but if you would be looking at residential or commercial securities as a mix, and which markets would be the most interesting to you at this point from a diversification perspective. What would you do with $2 million? And by the way, everyone, this is not advice, by the way.
Okay, interesting game. So $2 million. If only this was a reality situation, Jack. Okay, I think I'd probably really first of all, I'd be going residential because that's what I know, but there's probably a much more legitimate strategy of diversifying into non-residential in some markets. But I'll stick residential because that's what I know. I'd probably be putting, say, 750,000 of that into the Perth market, looking for a bit of a sugar hit on the capital gains at the moment. A house rather than an apartment. Middle ring to outer ring is probably the only area that you'd be able to buy into with that sort of money. Mm-hmm. Into a good rental market as well. So the sort of areas around Perth would be, I guess, getting towards, Mandurah is a really good option, even though it's quite far to the south. It's got a good transport connection and pretty affordable. Seems to be quite popular now, especially with hybrid working conditions. So that's number one. I think you'd probably get a good capital return and a pretty good rental return over the immediate couple of years. The second one would be probably Brisbane. Again, a detached house, hoping to buy within the Brisbane LGA if I could. If not, maybe in the corridor between Brisbane and the Gold Coast, which is more sort of Logan, Coomera, that sort of area, or getting a bit further north. Or even Toowoomba, being a fairly affordable market that's become quite popular and is showing good returns as well. And then that leaves me probably a third option, which, as a longer term investment opportunity, I'd probably be looking at Melbourne and maybe delaying that decision to purchase for another year and a half or something like that until I was fairly confident the market had sort of reached a turning point. So yeah, hopefully that makes sense. And
a bit of diversity between the sugar hit in Perth and then also a long shot on Victoria. So that sort of diversity strategy, and also I imagine, from a yield perspective, you're also getting a bit of diversity between the two markets as well. Would that be right to say?
Yeah, absolutely. And I think even just diversifying between Brisbane and Perth, like the markets are quite different economic conditions, different demographic factors as well. And but yeah, I think Brisbane probably has more longevity and may not show as much of a strong return immediately, but you'd think over time, given some of those factors we talked about with the Olympics Games down the track, but also big infrastructure projects and the population growth trend, I think probably is quite sustainable.
All right. Well, Tim, that brings us to the end. Thank you so much for your time. I can't actually really believe we could get you, to be honest, but thank you so much for joining us and for taking the time. And I dare say I'll probably see you on another function or event soon. And just thanks so much.
No doubt. Thanks, Jack. It's been an absolute pleasure having a chat. Cheers, mate.
I really appreciate it. Thank you so much. I'll see you on the next one.